Richard Jerram, Chief Economist of Bank of Singapore as well, joins us now on the show live to talk about how he feels the global economics is likely to pan out. Richard, hi, morning. Thanks for taking time out and joining in. Firstly, let's start off with China. How deep are the concerns this time around? Because one has been hearing about a hard landing when it comes to the Chinese economy for a while now.
Yeah, there's been hard landing talk on and off, as you say, for the last 3 or 4 years. I think the difference now is that in the past 3 or 4 years, every time the economy slowed down, you were fairly confident that the government would come along with some support for it, generally by loosening credit conditions. I think now when you look at all of the problems they have in the credit market and with the excess credit boom there's been over the last 3 or 4 years, you're much less confident that the government is going to be able to come to the rescue of the economy as it slows down.
Richard, when we started the year, it was all about what US Fed could do, what US Fed will do, and how tapering could have an impact on global liquidity. But if I map the flows into emerging markets like India or Indonesia, they are quite constructive.
Yeah, I think the markets have matured a little bit in the way that they're looking at the consequences of tapering. I think they're looking at some countries that look very vulnerable. And obviously a place like Turkey with a very large external deficit looks extremely vulnerable. But I think they're discriminating in that they're looking at, say, India and Indonesia, which were under pressure 6-9 months ago. They've taken quite a lot of policy measures, both structural measures and also monetary measures. And I think in response to that, they've instilled a little bit more confidence in the currency and in the sustainability of the economic model. I think as a result, India and Indonesia have been notably left out from the pressure on emerging markets since the start of this year, and I think that's quite a reasonable assessment by the markets.
How much of the current appreciation in Indian rupee is a function of better macro governance, decent trade data, and a decline in inflation?
Yeah, I think all of those things are playing a part. I mean, if you think back 6 months ago, it looked as if there was a reasonable risk that the whole thing could spiral out of control, that the inflation was pushing up, that the currency was weakening, the deficits showed few signs of coming under control. But the policy measures really have been, I'd say, surprisingly effective. And so, given that, I think you've seen a fairly well-supported rally in the currency. And I think those absolute meltdown risks have diminished. I mean, of course, growth is still terrible. But I think the first thing is you have to address the inflation problems and address some of the more structural problems, and then you create the environment for growth for return. And I think the hopes are that will happen over the next year or two.
Richard, what's the view when it comes to India? Because our markets have been scaling lifetime highs. At the same time, exports are slowing down, and the current account deficit data, which was recently posted, that seems to be doing pretty okay.
Yeah, well, I think broadly across the emerging markets, there is pressure, but I think investors are looking for any market which is showing some idiosyncratic behavior, is showing some detachment from this general liquidity-driven move that we've been seeing in recent months. But I think if you look at a market like India, where obviously markets are forward-looking, and I think the markets are looking at the prospect of political-led policy change, maybe more effective policy implementation, and as a result, they're almost buying that hope. I'm not sure they're necessarily buying what's happened over the past few months, but I think they're buying the hope that some of the structural barriers that have been a real problem for the last few years will begin to diminish after the elections.
Richard, markets always focus on one thing, rate of change. Do you think rate of change now for India is going to be constructive, irrespective of the big event, which is election?
Well, I think the rate of change on inflation is quite helpful, and we'll have data later today that should show further slowing down of consumer price inflation. I think it's probably a bit early to think that the rate of change in terms of growth is going to start to improve significantly. But I think if you take a view on the next 6 to 12 months, sure, the next move for growth should be acceleration rather than a further deceleration. So I suppose if you're looking that far forwards, you can probably hope to see some pickup as the months go by this year.
Do you think India could go back to 6% plus, or that is still a dream number in terms of GDP growth?
I think 6% is possible if you see some big policy improvement. I don't think you can go back to the sort of the 8% plus that we had a few years back, but there's no reason why it should be languishing sub 5% if you see a moderate amount of policy improvement over the next year or two.
What about Indian equities though, Richard? Does it seem like there could be a massive pickup from now up until elections in anticipation of what the opinion polls are throwing up?
Well, that's a tough one. As you say, there's been quite a big move already, so presumably quite a lot of hope is in the price. I think there's also, maybe some concern that the election doesn't prove to be as conclusive as maybe markets would like, and then you get a scrappy sort of coalition building after the election. And I think if that happens, that might act as a bit of a headwind. So I would think that people are going to exercise, a bit of caution now, given the uncertainties of the outcomes.
Richard, final question. It's not only India, but most of the major markets, at least the big markets, are up 2 to 3 times from the 2008 lows. Do you think one should get worried about lofty levels, or the way to look at equities is that the way forward is looking much better? It doesn't matter how much you've appreciated. What really matters is valuations and the economic outlook. And valuations and economic outlook, they both are looking slightly appealing.
Yeah, I think the percent change from the absolute distress levels of 5 years ago is pretty much irrelevant. I think you have to look at valuations. And I think if you look at valuations for most of the markets, it suggests they're a little bit on the expensive side, but not aggressively expensive. And I think if you believe in the idea that there is a pickup in growth in the developed economies taking place at the moment, you get earnings growth coming from that, then I think you can make a reasonable case for a moderate gains in emerging markets and the developed markets in particular. But I mean, you're not going to be shooting the lights out. Prices are probably not going to double from here over the next couple of years, but you could be seeing 10% give or take type of gains based on the earnings improvement. So we're positive on equities. I mean, we're not wildly bullish, but we're basically moderately positive.